costing us $1.10 per widget, okay? And we're selling these widgets for $2, okay? And let's say that we're selling these widgets for $2 and we're trying to figure out what our net income is. What is our net income if we're using LIFO?
It's less than the other.
We're selling our widgets for $2. So what's the net income if it's LIFO?
90 cents.
90 cents, right? What if it's FIFO? $1, okay? Why is it that someone would want to use LIFO versus FIFO? What are the relative benefits? Well, if you use LIFO, you're probably always going to have lower net income, right?
Right.
And that affects your tax rate, right? Because you're generally only taking taxes off of net income, right? Although tax accounting is actually different. Tax accounting is generally cash-based, right? Maybe you don't want to show your net income, right, to your competitors, right? If you use LIFO, the cost of your inventory is going to be higher, the value of your inventory. You're going to have higher assets. That could affect your debt rating, right? Because you always want to have higher shareholder equity, right? When you're going out to issue debt. So there are a couple of these little considerations in there. One of the problems is that this makes comparability harder, right? Because it's very difficult to switch from LIFO to FIFO. If you're one of these firms that makes a business of standardizing the values so you can make them more comparable, it's very difficult to convert from LIFO to FIFO because you have to know the value of each unit in the inventory, right? So, all right. Let's see. Fixed assets, plant, property, and equipment. Less accumulated depreciation. What were the three ways of depreciating?
Straight line.
Straight line. Declining balance is some of the.
That's right. Some of yours. So what are some of the advantages of using those different ways of doing depreciation?
Straight line, it's stable, because every year you take out the same amount.
Right.
Declining balance, it's you're taking out more in the beginning.
Right. So reduce your net income up front.
So you're nothing out of that.
It's more front-loading the expenses, right? One of the things you want to worry about is over time you're going to lose those assets in the balance sheet, right? And that will affect your credit rating, right? Because one of the components of looking at a credit rating is your shareholder's equity, right? So if you're getting rid of that, okay, if you're getting rid of it more slowly, okay, you've got higher upfront net income, right? And you've also got more shareholders' equity over time. But oftentimes people also like to show higher net income because they want a higher stock price. And that's why people try to get rid of it up front, right? Especially when they're a company that's going to be losing money for a while. So they really don't care about how big the loss is up front. So they'll try to do double declining balance so they can get this out of the way, right? And then come back to it in the future.
It's not a good way to show how great your performance is. If you deduct everything up front, that means that the performance will be bad, but the following couple of years, all of a sudden, you'll have.
Right, that's what I was saying. If you're a company, like if you're a biotech company, and you know you're going to be losing money while you're doing your clinical trials, right? So get it out of the way. And that way you have higher net income later on. Okay. Goodwill. You want to give me a definition of goodwill?
When another company purchases, or I mean, when a company is acquired for more than its book value, that would be the difference.
It's the difference, right? And would you depreciate? How long would you depreciate the goodwill over? What's that?
You don't do acquisition.
Yeah, you don't do it.
You just annually appraise or maybe a certain number of years and deduct the value if it's not.
There were two problems with that statement. What was the other one?
Right.
Well, the statement I made, you caught one of them, which is that they've changed the accounting laws about 4 years ago,
Right.
right? So it's cash versus pooling, and then purchase versus pooling, I mean. And then what was the other problem with my statement? On depreciating the goodwill.
Depreciate is for retention.
Yeah, right, you would amortize the intangible. Okay. What's a deferred tax asset?
Cash accounting, or the one that's created for calculate your taxes to the government and one that's actually in the GAAP. There's a difference between the amount you pay in taxes, so it could be a liability or an asset based
There's
on.
several of these tax assets that are around. For example, net operating losses, right? You're doing a lot of losses, you can save those up, right? And use those to offset your taxes in the future, right? Different times that you pay the IRS, right? You may pick up a tax liability as you're generating income, right? But you only pay the IRS once a year, right? So you pick up a liability there. On the liability side, we've got accounts payable. What are generally the terms of accounts payable? You're a big company like a GM or a GE or a, what's that? 30 to 90 days, generally what you get, okay? Why is it good to have 90 days versus 30 days? Or is it? Is it better to have 30 days?
The company finances your.
Well, there's a time value of money, you're gonna have to pay it in 90 days.
You put it into a 90-day CD, right? Take the money out, give them the original principal, and you keep the interest. Current income tax liability, we have discussion, current portion of bank loans, short-term provisions. All right. Any questions on these line items? How much freedom are you allowed in determining which line items you want to report and which line items you don't want to report? Does Google have a cost of goods?
I would think you would have to.
Not in the traditional sense. You might have a cost of service, but even there, almost everything they're doing is R&D. I mean, I'm a Google Apps member, so I've got my person that I can call up and get help, but there's very little customer support. And you have to pay for that, right? $100 or whatever it is. You have a fair amount of freedom on which line items you want to use. A lot of these line items are overlapping, right? So if you want to use one line item instead of another line item, you have a fair amount of freedom, okay? There are hundreds of line items out there. If you go through all the financial statements in the SEC, I think the number is somewhere around 250 different line items, okay? And so you have a fair amount of freedom in selecting which ones you want to use. This is another problem with accounting. It's not everyone has the same line items. And FIFO versus LIFO, 3 different ways of depreciating. You also run into the problem that you can calculate the line items differently. Accounting has its problems. All right. On the cash flow statement, okay, we have credits and debits is one way of calculating the cash flow statement. You also have the indirect method, all right? So let's go through these quickly. On the direct method, for credits and debits, you simply take a look at, imagine yourself at the vault, at the bank, right? And money's coming in or money's coming out. And you just sit there and you count everything as a credit as a debit. It's coming in, it's coming out, okay? That's pretty easy to do, right? And then you can score it. Well, that dollar came from operating. That dollar that's going out is an investing dollar, right? This dollar that's coming in is from the issuance of equity. It's a financing dollar, and you can score it, okay? The other thing that you can do is the indirect method, which is you take your accrual-based accounting, you take your net income, okay, and you add back the non-cash items to get to the cash items. This is the way it's done on most cash flow statements, right? Rather than going through every transaction that occurs and coming up with an investing number, for a company like Google, that would be hundreds of thousands of transactions, right? Instead, you just take the net income and you subtract out the non-cash items, right? So what are some of the non-cash items? In operating activities,
Depreciation, amortization.
what are we missing up there?